Navigating the Maze. Essential tax deduction strategies for accounting professionals. Tax deductions play a pivotal role in optimizing financial outcomes for individuals and businesses alike. For accounting professionals, mastering these intricacies ensures accurate advice and maximizes savings for clients. From understanding legal frameworks to identifying overlooked opportunities, tax deductions demand precision and expertise. This guide delves deep into practical strategies and critical considerations every accountant must know. Understanding tax deductions, definitions and legal frameworks. A tax deduction reduces taxable income by subtracting eligible expenses, thereby lowering the amount of tax owed. These deductions vary widely depending on jurisdiction, taxpayer status, and type of expenditure. The Internal Revenue Code, IRC, provides the foundation for U.S. tax deductions, while other countries rely on similar statutory structures. Accountants must stay updated on local laws and amendments to advise clients effectively. Deductions fall into two broad categories: above the line and below the line. Above the line deductions reduce adjusted gross income, AGI, while below the line deductions affect taxable income after AGI is calculated. Common examples: mortgage interest, medical expenses, and retirement contributions qualify as deductions under specific conditions. Limitations: not all expenses are fully deductible. Many depend on thresholds tied to AGI or income levels. Eligibility criteria: what qualifies as a valid deduction? To claim a deduction, the expense must be both necessary and reasonable for the taxpayer's trade or business. Personal expenditures generally do not qualify unless explicitly allowed by law. Accountants must verify that deductions align with IRS guidelines. For instance, unreimbursed employee expenses may only be deductible if they exceed 2% of AGI and are itemized. Recent legislative changes and their impact. The Tax Cuts and Jobs Act, TCJA, of 2017 significantly altered deduction rules. Key changes included eliminating the personal exemption and capping state and local tax, SALT, deductions at $10,000 annually. These adjustments necessitate recalibrating client strategies. For example, high-income earners previously offsetting SALT deductions now face alternative approaches to optimize tax liability. Type of deductions: standard versus itemized. Taxpayers choose between taking the standard deduction or itemizing deductions. The standard deduction simplifies filings but often results in higher tax bills compared to itemizing. Itemizing requires meticulous record keeping. Clients with substantial qualifying expenses, such as medical costs or charitable gifts, may benefit from this approach despite increased complexity. For 2023, the standard deduction amounts are $13,850 for single filers and $27,700 for married couples filing jointly. These figures influence whether itemization becomes advantageous. Business-related deductions: maximizing corporate savings. Businesses enjoy a wide array of deductions, including operating expenses, salaries, and depreciation. Proper classification of expenses as either ordinary and necessary is crucial. Closely held corporations must distinguish between shareholder and operational expenses. Misclassification risks disallowance during audits and potential penalties. Section 179 Expensing allows immediate full deduction of qualifying equipment purchases up to specified limits. Bonus depreciation accelerates depreciation schedules for new property, offering significant early year savings. Home office deductions: navigating remote work complexities. With the rise of remote work, home office deductions have gained prominence. Eligibility hinges on exclusive and regular use for business purposes. Two calculation methods exist: the simplified method, $5 per square foot limit, and the actual expense method. Choosing the optimal approach depends on client-specific factors. Landlords renting space to tenants for home offices must adhere to strict rules to avoid disqualification. Documentation proving usage patterns is vital. Healthcare and insurance deductions: Beyond premiums, medical expenses exceeding 7.5% of AGI become deductible. This threshold applies to out-of-pocket costs, prescription medications, and certain dental procedures. Health Savings Account, HSA, contributions offer triple tax advantages: pre-tax contributions, tax-free growth, and tax-free withdrawals for qualified healthcare expenses. Self-employed individuals can deduct health insurance premiums as an adjustment to income. This provision supports those without employer-sponsored coverage. Educational expenses, from tuition to certifications, tuition and fees for degree programs remain deductible only if the course leads to a profession requiring credentials, such as law or medicine. Other educational pursuits typically do not qualify. Student loan interest deductions allow up to $2,500 annually, subject to income limits. This incentive encourages investment in higher education. Professional certifications and seminars may qualify as deductible expenses if directly related to current employment. Documenting relevance to the taxpayer's occupation is essential. Charitable contributions, strategic giving and record-keeping donations to qualified charities can lower taxable income, provided proper documentation exists. Cash donations over $250 require written acknowledgement from the recipient organization. Non-cash contributions necessitate appraisals for items valued above $5,000. Maintaining thorough records prevents disputes with taxing authorities. Qualified conservation contributions enable deductions for land donated to preserve natural resources. These specialized deductions demand careful evaluation of eligibility criteria. Mortgage interest and property taxes, staying within limits. Mortgage interest on primary residences remains deductible, limited to loans secured before December 15, 2017, and up to $750,000 in principal. Refinancing post-2017 may restrict eligibility. Property taxes are deductible up to $10,000 annually for SALT. This cap affects homeowners relying heavily on this deduction for tax optimization. Rental property owners face distinct rules. Mortgage interest and property taxes on investment properties are fully deductible against rental income. Retirement contributions, double benefits for savers. Contributions to traditional IRAs and 401(k)s reduce taxable income in the year made. Roth IRA contributions, however, are made with after-tax dollars and grow tax-free. Employer-sponsored plans offer additional incentives. Matching contributions increase retirement savings while providing immediate tax advantages. Self-employed individuals can deduct SEP IRA contributions and solo 401(k) contributions against business income, enhancing overall tax efficiency. Travel and entertainment expenses, balancing business and pleasure. Meals and entertainment expenses for business clients are partially deductible at 50%. Travel costs incurred away from home for business purposes are fully deductible. Vehicles used for business trips must be tracked via mileage logs or percentage of business use. Failure to document properly risks denial of claims. Recreational activities, even if indirectly related to business, rarely qualify as deductible expenses. Clear separation between personal and business spending is paramount. Fine and penalty deductions, when are they permissible? Fines imposed by government entities are generally non-deductible. Penalties resulting from negligence or fraud also cannot be claimed. However, certain court-imposed fines may be deductible if levied for violations unrelated to federal tax matters. Clarifying intent and context is crucial in these cases. Legal representation fees associated with disputed fines may be deductible if the matter relates to non-federal taxes. Expert consultation helps determine eligibility. Conclusion: this guide underscores the multifaceted landscape of tax deductions, emphasizing the need for vigilance and adaptability in practice. Mastery of these nuances enhances service quality and client satisfaction. Continuous learning about evolving legislation ensures accountants provide cutting-edge advice. By leveraging available deductions strategically, Professionals empower clients to achieve greater financial wellness.